Welcome back to Street Smart. We've talked a lot on this program about life after QE2. Since Fed Chairman Ben Bernanke announced the bond buying program last August, the S&P 500 has risen more than 25%. So what happens when QE2 sails into the sunset? Investors gave their predictions in the latest Bloomberg Global poll. 43% of participants say the S&P 500 will fall after QE2. An additional 37% said there would be no change. That's 80% of respondents saying stocks will fall or stay the same. Meanwhile, 17% said stocks will actually rise. More than 1,200 investors, traders, and analysts took part in this survey. One of them is Craig Dismuke. He is chief economic strategist at Vining Sparks, a global broker-dealer that trades $230 billion a year. Craig, welcome to Street Smart. Thanks so much for joining us.
Hey, thanks for having me.
It doesn't look like the market is too psyched about the end of QE2 here. I mean, most of the people that we asked said that the market would be flat or fall. What do you think?
Yeah, we fit into that category, Matt, and it's you have to look at what QE2 is doing right now for the markets. It really, if anything, it was a safety net that acted to prevent maybe a broader turn down, prevent a deflationary period. And so it acted as a safety net to prevent that. And so I'd say it gave the markets a little bit of freedom to run. Maybe it increased the risk trade a little bit. But the bottom line is it's not necessarily, it's not QE2 that's boosting stocks.
What is it? I mean, we hear that there's still going to be loads of liquidity after QE2 is done. Obviously, they're not going to drain it all right away. Ben Bernanke's been sort of telegraphing that to markets, actually saying it directly in his press conference. So what is it that's been boosting stocks, if not the liquidity that the Fed's been adding to the system?
Well, and for what it's worth, we don't make a business out of following stocks. Certainly, we follow them to the degree that they affect our economic forecasts. But it's really, I think what's driving stock prices more than anything is just corporate profits, and they've done well, and so we've seen stocks run as a result of that. But if anything, I think QE2 has probably driven bond prices to a certain degree, but more than anything, commodities and oil and speculation there.
So, but corporate profits, I assume you expect corporate profits to keep coming in, making the market happy, better than expectations of analysts. What does the post-QE2 world then look like? I mean, do commodities come down as a result?
I would expect to see commodities come down a little bit. I would expect to see oil come down a little bit, and that's what's important to us right now. We're really watching the oil prices. I don't know that corporate profits will continue to be above analyst expectations. I think you see there's increases in input costs, and so I think that's going to drive margins a little bit tighter. And we hear from retailers really pretty frequently now that they're going to try to push some of these costs on and see if they can push those through to the consumers. And I'm not convinced that the consumer is stable enough yet to be able to do that. So I'm not convinced that corporate profits will continue to do as well as they have. And so that's why we look at stocks and say they're probably going to be flat, and maybe they fall a little bit, if anything.
Although, a lot of people blame the Fed for the boost in commodities prices. If QE2 stops those gains, and even if the gains turn around, that's got to lower input costs and also give the consumer a little bit extra cash in his wallet.
Yeah, that's right, and it will. But you remember, they have to flow through a supply chain, and so that's going to be a little bit while before that occurs. And so that's going to take some time. Really, when we look at commodities and oil, with the end of QE2, we're hoping to see those come back in because that's what's driving inflation right now. And if you look at the inflation numbers this morning, almost all of it came from gasoline prices. If you look at the core level, core inflation came in at, I believe it was 0.4% month over month, 1.3% year over year. So there's not a lot of inflation there, but so it's all coming from oil right now. And so the problem we have with oil prices being so high is that they're dragging on consumption. And so the retail sales figures that came in this week showed that retail sales were advanced a little bit, but there was a big chunk of that was being taken out because of gasoline purchases.
I saw that motor fuels over the past 6 months up 66%. Quite a huge jump there. What do you think on the fixed income side? I mean, if inflation isn't a concern with the reduction in commodities prices going forward, then tightening surely wouldn't be a concern either.
No, I mean, we don't see them tightening anytime soon. When we look at what the Fed's doing, we'd expect that to be into 2012. I think the futures contracts right now are projecting it won't be until July of 2012. That's a little bit of a shift out. It was at March earlier in April, I believe. It was pricing for the first raise to be in March. So, if you see inflation expectations start to drop because commodity prices or oil prices fall, then we would expect to see a pretty good bid in bonds. So, when QE2 ends, well, if you look back at the history of QE1 and QE2, in both scenarios, bond yields rose when the Fed started buying bonds. So it goes a little bit again. It's a little bit counterintuitive. The reason they rose is because inflation expectations, and we look at the TIPS break-even level, those rose as the Fed starts buying bonds. And in QE1, the TIPS break-even level on a 10-year rose about 150 basis points. During QE2, it rose about 100 basis points. And so that necessarily pushed bond yields higher. And that's what drove that trade. And when the Fed quits buying bonds, if the economy is stable and just a period of low growth as we expect, then I'd expect to see inflation expectations drop and see bond yields sticking in the 3% range.
Got it. Hey, Craig, it's very complicated stuff. We appreciate you walking us through it. Craig Dismuke there of Vining Sparks coming to us out of Tennessee.